show then with a conversation I had with Manu Rikhye, who is the partner at Merak Ventures, as they talk about their focus of investing in climate tech, SaaS, as well as insurtech, EV, carbon and digital solutions. Listen in.
Yes, thank you for having me here, Avanne. This is a great opportunity to talk about what we do. So we are a B2B tech-focused fund, but within B2B tech focus, we're sector agnostic. We're looking for founders that are interested in solving real-world problems that make a real impact in the world. So think of ideas that matter. We come in at very early stage. We're happy to come in even at an idea stage. You talked about space tech. One of our portfolio companies called Pixel, when we invested in them, the two founders were still in college, and we were happy to partner alongside them. So from idea stage to very early revenue stage is when we come in and then work alongside founders and handhold them in their journey from seed to Series A, from 0 to 1, as we call it.
Okay, fair enough. And what has been your observation, if you will, in particular when it comes to the climate tech space as a whole? Because while now everyone can't stop talking about themes like EVs and digital solutions, a few years ago, perhaps it wasn't the hottest sector to be in. So what has been your observation on how the sector has really evolved? And more importantly, what kind of potential do you foresee down the line?
Yeah, I think one of the things that all of us as individuals and citizens of this world are realizing is that climate change is real. It's affecting everybody's life, your and mine, as much as anyone else on the planet, which basically means that more and more people are getting interested in addressing this challenge that humanity faces, which is very exciting. I think that recognition becoming more real is also going to make more capital available and drive the right set of conversations between founders, investors, policymakers, and various stakeholders. The challenge that sometimes happens when there is too much interest is it creates noise and confusion. And climate tech as a sector is also going through a little bit of that shift, right? There is a lot of focus around it. And sometimes we also find founders force-fitting ideas into everything becomes climate tech. So our job as investors is to find founders who are passionate about addressing this challenge that humanity faces, have identified a very specific, narrow problem, have wherewithal to address this problem by creating a solution that is viable, that can stand on its own 2 feet, and then work alongside them in helping them build that, in helping them scale that. I think the good thing that's also happened is now there is enough patient capital available that will work alongside this top talent to create long-term impact, long-term viable businesses that will change how we're dealing with some of these issues. And those changes could range from looking at agri supply chain as an example. So if you look at India, we've always had an inefficient agri supply chain. A lot is produced, but a fair bit of that gets wasted from farm to the fork. Can we improve that? There'd be businesses that will get created that will help finance these climate tech opportunities, right? So think of solar. There's significant adoption in solar, but how do you finance this adoption of solar solutions by businesses or homes? So that opportunity around financing would exist. There'd be other data-led businesses that will help monitor various businesses and their impact on climate and help them become more efficient. So I think all in all, that's going to be tremendous interest, tremendous innovation, and we're just excited of working alongside some of these founders in helping them achieve that objective.
Yeah. So Manu, given that you're looking at seed stage B2B and emerging technology companies, how critical do you think is it for a lot of these companies to really utilize new technologies, and how critical is it, do you think, to adapt to the ever-changing technology landscape?
That's the largest challenge that a founder faces today, that when they start a business, technology landscape is of a certain type, and it's not static. So it's ever changing, and it's changing at the faster rate than we've ever witnessed in at least our living memories. So the ones that are successful, the businesses that are successful are businesses that are nimble, that are agile, that can integrate and adopt some of these technologies faster to address the use case. Technology is nothing but a tool. I think founders that respect that, understand that, and can find applications of that tool are more likely to succeed. So today you may use a hammer and tomorrow you may use a spanner, because cost of building an operation has gone up, right? So today founders have to pay more salaries, they have to pay higher tech costs. So, what you could build in $500,000 earlier, you probably need $1 million easily now. And we're cognizant of that and appropriately fund the businesses.
What's been your assessment of the cleanup act, if you will, that a lot of startups as well have been taking, be it the layoffs that we've seen, companies as well focusing on the path to profitability. Is there still a long way to go, or is it positive that we're at least seeing baby steps or steps in that direction?
I think there's a long way to go. Abundance makes any society lazy, dumb, and fat. And what's happened here is that there has been an environment of abundance over the last few years, which has led to all of us in the ecosystem becoming a little bit more complacent, including founders and companies. This new environment is driving focus around fundamentals, like you said, right? Unit economics, profitability, path to sustaining the business on its own without requiring external capital, which is bringing changes at multiple levels, starting first and foremost with the mindset of founders and investors, where everybody is asking the right questions and bringing about strategies that will help deliver on these outcomes that I just outlined. I think this period of difficulty and pain is probably going to last for another 12 to 18 months, but it'll render the system far more healthier and robust. You will also find some very exciting businesses being seeded in this period, because it's also going to attract people and founders of very high conviction to take a leap of faith and in this environment and start to build a business. And the ones that will therefore build some outstanding businesses that we will look back a decade later and would be amazed by. And, I'm sure they will touch all our lives in some way or the other. So there's a mixed bag. There is some amount of pain. There is some degree of excitement. But when you look back at this period, we'd all collectively say that this probably was the best thing that happened to the Indian startup ecosystem.
Yeah, fair enough. A cleanup act and emerging, healthier on the other side. So, Manu, walk us through, the investments that you made in startups. Anything that really stands out?
Sure. So, like I said, we've been investing in businesses that are looking to solve real-world problems. We have been investing through two vehicles. First, we were investing through the Merak Ventures fund, and now we're investing through the Merak fund. Both are investing in the same thesis. And from the Merak Fund 1, which is now fully deployed, we made the last investment, our 17th investment, in a company called Onestock. All across the 17 companies, you'd see that there is this theme where people have built some very valuable businesses that are highly capital efficient. Each of our business needed far lesser capital than many others in the industry. Some of the early winners from our portfolio are companies like ProcCap. ProcCap's building a working capital finance solution for retailers in tier 2, tier 3 cities. Think of people selling cell phones, consumer durables, white goods, even cement and steel now. These retailers are finding it very hard to access formal credit, especially as a working capital product. And that's what ProcCap has solved. It's gone to the anchor brands like Samsung and, in terms of cell phones, Oppo and others, and, kind of built that whole supply chain out and provided these retailers the access to this formal credit, which has in turn improved their disposable income and helped them sell more. The other company is Pixel, which is building constellation of hyperspectral imagery satellites. I referred to them earlier. They were young boys in college when we invested in them. In the last 4 years, they've actually launched 3 satellites. 2 of them are operational. These are capturing very high quality data from space, which can then be used for agriculture. It could be used for mining. It could be used by businesses focused around climate, right? Monitoring of various landscapes. And then there is other businesses which are more tech enabled, like Advantage Club, which is an employee engagement and retention focused business, which is helping people reward their employees far more effectively and make it fair and transparent and make it very easy for employees to consume these rewards. India's leading brands and employers are now using Advantage Club as a solution to drive up engagement and belongingness and pride amongst their employees. Our final, most recent investment is in a company called Onestock. Onestock is building a stack of technology and solutions for cooperative banks and credit societies. So in the last decade or so, a lot of the innovation around fintech has been focused around the larger banks of India, and customers like you and I. But 50% of India's bankable population lives away from these cities, operates through these banks, which are credit societies, cooperative banks. The deposits that these banks hold today are to the tune of 11 lakh crores. These banks have lent about 16 lakh crores. And yet, for many of these customers to avail UPI through their bank has been very difficult and challenging. They haven't been able to access simple facilities like that. In order for them to know their bank balance, they've had to go to the bank branch. Onestock has built some very interesting, exciting, simple to implement technology and tools that is digitizing these banks and helping the end consumer access financial products and bringing them at par with folks like you and me.
Good to have you on board. Thanks so much for joining in and giving us more clarity and perspective on the investments and the style of investing.
Thank you so much. Thank you for having me here.
Meantime, beauty major Nykaa came out with its quarterly numbers and it was a weak performance. The top line failed to meet street expectations and brokerages have been downgrading the stock. Let's delve deeper into the financials then, and we've got Vinny who joins in with a roundup of Nykaa's quarterly performance. Vinny?
Absolutely, weak numbers have come in from Nykaa, and the main pressure that is coming in from Nykaa in the last couple of quarters is from that fashion business of theirs. That's not done well even this time around. That's an overhang that is there for Nykaa even in this quarter. And obviously, when you're looking at it, the growth for fashion segment has come in at 12.3%. The GMV over there and discretionary spends, that was hit, and that is why we're seeing that the fashion segment has also not done well this time as well. Though the company has highlighted that they will be focusing on improving the business. Festive season is coming where they expect the profitability to start improving. Though the BPC segment, yes, that's done well. The moats have been maintained in the BPC segment and they're continuing to do well. We've seen a 24.3% growth in GMV for the BPC segment as well. Even average order value, that's seen a growth of 4% on a year-on-year basis as well. And the management is highlighting that they've gained some market share in the BPC segment. That's a beauty personal care segment. But clear pressure that has come in and an overhang that has come in from the fashions business. Now, on the back of that, what we're seeing is BofA has actually downgraded Nykaa to a neutral rating after the miss in Q1 numbers. Slowing growth is what they are highlighting. Less valuation supportive. Downside risk remains in terms of competition pressure that is increasing as well. And that is why they're cutting their FY23 to FY26 EPS by 17 to 39%. Multiple cut from 15 times to 13 times as well. And cut the target price to 160 rupees per share from previous 175 rupees per share. Macquarie too is retaining the underperform rating given a target price of 120 rupees per share. They're highlighting that the ad income also is a bit of a weakness coming in there, while Morgan Stanley on the other hand is still maintaining their overweight rating on Nykaa and given a target price of 175 rupees per share. So let's keep an eye out on Nykaa today, down and out in trade after a weak set of numbers.
Thanks for that, Vinny. Moving right on then, let's focus in on the IPO market then. And TVS Supply Chains, which is a logistics solution provider, they closed for subscription today for the IPO. What has been the overall response? Let's take it across to my colleague Ankita Saxena, who joins in with the updates. Ankita?
So a lot of action happening in the primary market this week. Today is the last day to subscribe for TVS Supply Chain Solutions IPO. And if you look at the subscription numbers as of 11 a.m., we have QIB has been subscribed 0.15 times, NIIs have been subscribed 1.26 times, retail has been subscribed 4.98 times, and it has been subscribed a total of 1.35 times. Now, on the 18th of August also, we are expecting Concord to list on the bourses, and of course, it had a total issue size of 1,551 crore rupees, out of which the offer for sale was for 1,551 crore rupees, because we saw Helix Investment selling their entire stake, 20% stake in Concord. And considering the upper band of the IPO of the Concord Biotech IPO and the current premium that is going on in the grey market, the estimated listing price of Concord share is likely to be somewhere around 886 rupees a piece, which is 19.5% higher than the IPO price of 741 rupees a share. Now, next up is Pyramid Technoplast, which is opening up for subscription on the 18th of August. It has a price band of 151 rupees to 166 rupees per share. It has a total issue size of 153 crores, out of which the fresh issue is for 91 crore rupees and an offer for sale for 61.75 crore rupees. Next is Balaji Specialty Chemicals, which is opening up for subscription on the 18th of August again, and it has a total issue size of 425 crore rupees, out of which the fresh issue is for 250 crore rupees and an offer for sale for 2.6 crores equity shares for rupees 2 each. So that's the roundup of the entire IPO action that's lined up for this week.
Moving right on then, let's focus in on some exclusive reports then from the Economic Times, which suggest that the Manipal Group's Ranjan Pai is in talks for investing about 250 crore rupees in FirstCry as part of a broader secondary sale at FirstCry with a valuation of close to $3 billion. We've got Digvijay Mishra, who's joining in, reporter with the Economic Times, with the updates on that story. Digvijay, what exactly are you picking up?
Today morning, we broke the story of Manipal Group Chairman Ranjan Pai looking to invest about 250 crore in e-commerce firm FirstCry. This would be part of a bigger secondary share sale that could go up to about 500 crore rupees in total. Besides Pai, there will be other institutional investors who will be joining in as well. Interestingly, this comes at a time when FirstCry is being seen as one of the portfolio companies from SoftBank, which will go public next year. In fact, in a recent interview with ET, SoftBank's Navneet Govil told us that companies like FirstCry will file their draft IPO papers before the end of calendar year 2023. So with that context, the secondary sale is happening, and also FirstCry wants to have more local investors on its cap table. So that's all that's coming along as part of the deal. And what's also interesting is that Mr. Pai is also increasing his exposure to new age firms, as he's close to investing about $80 million in Baiju's own test prep subsidiary Akash, and he's also looking to invest a significant amount of capital in PharmEasy, which is linked to a rights issue which will open later this month, we are told.
Thanks very much for that, Digvijay. Let's move right on then and hear it out from N. Jaykumar of Prime Securities as he shares his outlook on the valuations that new age fintech companies command.
Especially given the overbearing nature of tech that is involved, that what can disrupt some of these things. Of course, it's true that some of these have become habit formation. We order our food, we order our cosmetics, we order our various things, pretty much online. Are we willing to pay excessive amounts which are left behind as margins for these companies? I'm not so sure. So I think you will come to a situation where some of these companies will hit the market for new rounds of funding, as is happening in the case of PharmEasy and others which we hear about, right? Yeah. Where they're going in for new funding. And funding is, again, an important pointer here. In a listed company, when you need funding, you go for a rights issue, supposing, yes, and you go at a discount to market to price it to sell. And like pharmacy has realized that whatever price you're able to raise money, please raise, because survival is the most important metric right now. We'll talk valuations later. So I think some of these new age companies will be seeking new funding. And to my mind, that's when they start getting derated, because you got to price it then to sell, not price it from a valuation perspective.
And if you're a startup who's looking at building your exposure and your brand's presence, we've got great news for you. The Times Network has launched Brand Surge, which is an initiative that empowers startups to achieve scale and surge ahead with innovative advertising solutions. Take a look.